Do you want guaranteed income that you can't outlive? Well, that's what income annuities are designed to do, but they're not for everyone. In this video, I'm going to show you how they work, when they may make sense, and what to watch out for without the sales pitch. Hi there, my name is Michael Baker. I'm a certified financial planner, and this is Carolina Retirement Club, where we help couples plan for retirement with clarity and confidence. So what is an income annuity? An income annuity is a contract between a contract owner, like yourself, and an insurance company. You give the insurance company a lump sum of money, and in return, the insurance company promises or contractually guarantees to return those funds to you plus interest in the form of contractually guaranteed payments at some point in the future. There are two main types of income annuities. There are immediate annuities and deferred annuities. Immediate annuities are often referred to as SPIAs. Single premium immediate annuities. These annuities are designed to begin making payments almost immediately. This period is usually after 30 days up to 12 months. So when we give them the funds, we are expecting to begin receiving payments almost immediately. Deferred annuities, or DIAs, which means deferred income annuity, are annuities where the lump sum is provided, but the payment period is going to be deferred, and this is typically longer than 12 months and could stretch out to years in the future. With both types of contracts, payments can be structured in a variety of ways. Here are some of the main ways that payments are often structured. You can have a single life payout, which means payments are based on the life of one person and they are contractually guaranteed as long as that person lives. This is the purest form of what we call annuitization, a life-only payout. This is where you give the insurance company a lump sum of money. They contractually guarantee to give you payments. If you pass away, the payments cease. You can also set up payment periods for a certain period where you are going to contractually receive payments over a set period of time, like 5 years, 10 years, 15, even 20 or 20 plus years. One of the ways that you need to look at is what exactly do you need these payments to cover and for how long? But you can design it to cover a period of years instead of a life or a life only period. Another way that payments can be structured is for a joint lifetime payment. This would be a payment that covers 2 lifetimes and not one. One of the things you need to be aware of is anytime you're looking at a joint lifetime payment, the payments are most often based upon the age of the younger person. For example, if you have a couple and a younger spouse, maybe 5-10 years younger than the older spouse, well, that payment is likely going to be based upon the life expectancy of the younger person. Depending on the ages of who's being covered, this could significantly reduce the potential payout factors. So you need to understand how joint payments are going to work if you want it to cover 2 lifetimes. Perhaps the most important thing to realize is that when you buy an income annuity and you begin receiving those payments, it's typically an irrevocable decision. So what are some of the key benefits when looking at income annuities? So first, it's the predictable income. Having a predictable paycheck each and every month or payout period that you've decided. Second is simplicity. With income annuities, there is no portfolio to manage. There is no market risk that needs to be monitored. You're getting consistent paychecks without the noise of a portfolio. Third, and perhaps one of the biggest benefits, is longevity protection. We talk about living a long life, but none of us really know how long we're going to live. That degree of uncertainty is addressed directly by having some type of contractually guaranteed income. With an income annuity, those payments can be structured to last for the rest of your life or the rest of the life for you and your spouse. So it provides longevity protection so that you don't run out of income. And finally, tax treatment. If you were to purchase an income annuity with after tax, or what we refer to as non-qualified dollars, There is some unique tax benefits that comes with the annuity protection. First, as we've discussed in other videos, annuities allow any type of appreciation to be tax deferred. Income annuities are different. When you annuitize after-tax money, that gain is spread out over the life of your payment period. So any type of gains or interest that's imputed in those payments, instead of having to pay taxes all at once, you spread the tax burden over a period of time. This can create some unique tax planning opportunities. And if you're in a tax sensitive situation, income annuities with large or non-qualified after-tax money could be a solution that makes sense. So what are the red flags? What do we need to watch out for? Just like every other tool, income annuities are not perfect. First, and I cannot stress this enough, this decision tends to be irreversible. Once you hand over your funds to the insurance company and the contract is beyond its free look period, the decision to place money into an income annuity contract tends to be irrevocable. Second, there can be inflation risk. When you put dollars into an income annuity contract and you begin receiving payments, many times those payments are level payments. When you have level payments over a long payout period, of course, we are going to experience inflation pressures on those dollars, meaning that as inflation rises, those level payments are going to have their purchasing power reduce as inflation takes hold. Inflation can be addressed in a couple of different ways. It can even be addressed with the income annuity contract. However, you have to be aware of how this would work. If you want inflation adjusted payments, most of the time you start your payments out at a lower level than you would if you were just going to receive the maximum level payment. So you have to decide, are you comfortable with the lower payment? And you should calculate how many years it will take you of receiving those payments before you get to the level payment period. The second way you can deal with inflation is you just do the calculation to figure out how much money it's going to take to get you back to that original level payment. So you either receive lower payments to begin with, or you have to likely put in more money to have your inflation adjusted payments start where the level payment would have started. Third, there is the estate factor. One of the most misunderstood terms in all of the annuity universe is this word annuitization. I've seen countless media stories and countless articles online that misrepresent exactly what they're talking about. Annuitization tends to be an irrevocable decision. However, only a small percentage of annuity contracts are actually annuitized. This is by far from being the default method in which people use annuities. However, we need to understand how it could work. Annuitization is receiving those payments, and it's typically an irrevocable decision. So if you were to pass away and there were no additional contingencies in the contract where there was a lump sum return of premium or a cash refund, and it's only a life only or a joint life only payment, and both the annuitants or people that are supposed to be receiving those payments die, there is no value that would go to the estate. This is one of the main reasons why people don't like to do the annuitization route, because they understand that in many cases, it's a gamble. If you die too soon, the insurance company technically kind of wins. If you live a long time, that's where you win. So many people want to plan for how annuities would fit in an overall estate plan. And finally, liquidity. Income annuities are not designed to be liquid accounts or piggy banks. So you need to have additional funds set aside for liquidity and large purchases or even emergencies. The immediate income annuity or the deferred income annuity is not going to serve as a liquid account. So when might this type of annuity make sense? Here are 4 scenarios where income annuities could make sense as part of a retirement plan. First, if you're retiring and you have no pension and you would like to have some type of structured or guaranteed income coming into the household, an income annuity may fit the bill. Second, if you're more risk averse and you want to avoid market fluctuations and their impact on your potential income, having some type of structured or guaranteed income can reduce some of the risk that you may be taking with your overall portfolio. Third, if you're looking to cover a certain minimal level of spending or essential fixed expenses in retirement, things like auto loans or mortgages or certain payments. Basically, an annuity can allow you to lock in a certain level of spending on a contractually guaranteed basis. Lastly, if you have large amounts of after-tax dollars in your overall portfolio and you're looking to take advantage of some of the tax deferral nature of annuities or the exclusion ratio that takes place with annuitized payments, a non-qualified income annuity could be a right fit for you. But here's the key. It has to fit as part of your overall plan. No financial tool is universally good or universally bad, but tools can often be used incorrectly or in the wrong circumstances. If you're wondering whether or not an income annuity would make sense in your situation, here are some questions that you can ask. Do I already have enough money from Social Security and possibly a pension to cover my essential living expenses in retirement? Or do I need more? Am I comfortable giving up access to some of my money in exchange for a contractually guaranteed income stream? Am I looking for income now, or would a deferred income stream be a better fit for my circumstances? And of course, what does this annuity look like with the rest of my overall income plan? How does it fit in with the entire plan? So the most important thing you can do is do your own due diligence and understand, does an annuity make sense for you? And if so, what type of annuity would be most in alignment with your own personal goals and values? If you'd like personalized help just evaluating your options, click on the link below and schedule your retirement vision call today. No pressure, just clarity. Are you more focused on growth or income in your retirement plan? Let me know in the comments. If you want to see how an income annuity might fit in the overall context of a retirement plan, check out the video on the screen right now.